Guys, good morning. Welcome back to Lessons from the Fall. It's been a hectic few weeks. I'm currently in Sydney with the team from Renown Lending, and honestly, the energy right now feels different. We've been filming a whole heap of short form content, meeting brokers, meeting investors, reviewing deals, talking strategy. And the one thing keeps coming up in almost every conversation: private credit. Not just lending, not just property, private credit as an asset class. Um, and what's interesting is it's no longer a niche conversation. It's becoming mainstream. And I'm super excited about it because without private credit, Renown Lending wouldn't be here. Renown Wealth is our private credit arm. We take investors' money, sophisticated investors, wholesale investors, as well as warehouses. So I'm really excited that we're able to talk about private credit today. More and more investors are moving into private credit. Family offices, for sophisticated investors, even business owners, even people who traditionally only invested in shares or property are now looking at credit exposure differently. And the question is, why? Why is there such a major shift happening right now? And I'm going to be honest, because capital moves for a reason. Always. And at the moment, investors are looking for a few things. They're looking for decent yields. They're looking for security and consistency. Now, compare that to traditional markets. Shares have become volatile. Policy uncertainty is increasing. Tax conversations are changing investors' behaviours. And many people are starting to feel disconnected from the markets. That move aggressively based on sentiment. Now, private credit feels different because it's grounded in something tangible: assets, cash flow, and security. And for many investors, especially after the last few years globally, that matters. Now, let's simplify what private credit actually is, because people hear the term all the time now, but many still don't fully understand it. At its core, private credit is non-bank lending. Capital being deployed directly into businesses, developments, or borrowers outside the traditional banking system. And what's happening over time is this: banks have become slower, they're more regulated, they're more conservative. So gaps start appearing in the market. Developers need funding quickly. Businesses need cash flow solutions. Investors needing flexibility. And private lenders are stepping into that space. Now, here's the important part. Private credit isn't growing because banks disappeared. It's growing because the market changed faster than banks could adapt. And investors are recognizing that. They're seeing opportunities to generate strong returns through well-structured asset-backed lending. Returns that often outperform traditional fixed income investments. But, importantly, with real security sitting underneath, now, obviously, with real security sitting underneath, right? Now, obviously, risk still matters. This isn't risk-free. Nothing is. But in a properly structured environment where lending is conservative, where due diligence is very strong, especially at Renown Lending, where security matters, private credit becomes very attractive. And this is what we're seeing firsthand at Renown. More inbound investor conversations, more offshore interest, more people looking to deploy capital in Australia private credit. Because Australia is still seen globally as very stable, transparent, and we're legally structured. And when you combine that with asset-backed opportunities, capital pays attention. Now, something else I've noticed recently is this: investors aren't just chasing returns anymore, they're chasing understanding. They want transparency. They want structure. They want communication. They want to know where their capital sits and why. And honestly, I think that's healthy because the environment has changed. People are more aware now, more analytical, more deliberate. And that's creating a stronger private credit market overall. Now, while I've been here in Sydney with the team, filming content and having conversations, something became very clear to me. The shift is escalating. not slowly, quickly. And it's not just because of rates or policy or market volatility. It's because people are starting to rethink how they allocate capital entirely. They're asking different questions now. What's backed by real estate? What creates cash flow? What gives me yield without relying purely on market sentiment? And increasingly, the answer is private credit. Now, from where I sit, I think we're still pretty early. I think private credit in Australia is still evolving, still maturing, still becoming understood properly. And as that understanding grows, so will capital flow into the sector, especially as more institutional and offshore investors look for alternatives to traditional markets. Now, does that mean every lender is good? No, absolutely not. Structure matters, risk management matters, experience matters. And this is where I think the industry will separate over time. The operators who focus on discipline, transparency, and sustainability will continue to grow. The ones chasing volume without structure eventually get exposed, because lending always comes back to one thing: risk. And understanding risk properly, well, that's what creates longevity. So, when people ask me where smart money is moving right now, I think the answer is becoming clearer. Yield, asset-backed opportunities, private credit. Not because it's trendy, but because the environment is pushing capital in that direction. This is lessons from the fall, and sometimes the biggest shifts happen quickly, before everyone else realizes they've already started.